and I had talked about going to 10-year yield chart as a barometer. This has been a favorite pattern of mine. I've been showing it for the last few weekly analysis. This is a classic ascending triangle. Why is it ascending triangle? If I take the key resistance level near 4.35, 43.5 is 4.35, you can see that the line joins the late November peak, joins the peak towards February, this cluster of peaks near 43.5. It keeps failing every time. And then the 43.5 towards mid-March. Then it broke out. Early April is when it broke out. So what is the measured target? Take the bottom of this triangle. So why is it ascending? The lows are ascending. 37.85, 38.17, 40.38. So those ascending lows and horizontal peak or resistance calls it an ascending triangle. It's an ascending because the lows are ascending. The measured target is 37.85 to 43.54. Subtract that, add it to 43.54, measures to 49.23 exactly, 4.92%. Where did we close? We closed near 4.66 or 4.67%. So there is potentially, if you have a hawkish Fed next week, first of all, back in late December, early January, market was so bullish on rate cuts, market had even priced in 6 rate cuts. From there, as the inflation data came out in February, market took a big knee jerk. January data was hot. Then it came out in March, and then it came out in April. 3 successive inflation data being reasonably warm and hot is causing concerns, and Fed has indicated, if you look at their the way they have projected out in the market, they now expect only 1 to 2 cuts max for the year. Coming from 6, it'll come down to 3, and now potentially 1 to 2 cuts is all that the market expects. If that turns out to be 0 cuts, rather if it turns out to be any indication of a hike of rates, that would be very negative for the market. So right now, what could be the fundamental cause of the market to pull back? QQQ go to 377 is the 10-year yield. That's the barometer we need to watch. If the 10-year yield continues to climb, that measured target is 49.23, but what if it makes a cup here from 37 to 49? That's a beautiful cup. It gets a shallow pullback and then breaks higher. That would be even worse. A break above 5% for 10-year yield will not be market friendly, and market could get an even deeper pullback. That's something to worry about. I have a feeling it's not going to cross 5%. There's a very good chance. It's an election year. Fed will likely start becoming dovish again once it gets to 4.9. And we could see some impacts to the economy, labor market, and so on. And there's a good chance. And there's a bigger reason of why Fed would be very hesitant to let rates climb over 5%. It's the commercial real estate market. It's been the, call it the black sheep, call it the concern for the market for quite some time. Higher rates means that a lot of the commercial lending mortgages will renew at higher rates. They don't have good occupancy. That will cause significant sell-off in the market. In the banks, in particular, the small and medium banks will get badly hit, the regional banks, and it's not going to be good for the market. So it's a very good chance. Now the momentum is there. I doubt it's going to pull back. We will likely see a 4.9% plus print in the 10-year. But till then, maybe when the market correction plays out, and after that, if we do get a double top at a 4.9% and pullback, then it'll be definitely market bullish. So with that,